The final part of Chapter 7 has us describe and illustrate the reporting of cash and cash equivalents in the financial statements. When a company has excess cash, they invest it in a highly liquid investment. Highly liquid investments are ones that can quickly be turned into cash. Something like a savings account, you can very quickly take money out of it, or a certificate of deposit, you can relatively easily take money out of it. You do get charged a penalty if you take it out early, but it's still highly liquid. It's easy to access that money, and so that's a cash equivalent. Companies that have the excess cash invested in cash equivalents, they put it all together as one amount on the balance sheet because for all practical purposes, it's the same thing. Some banks require that you keep a minimum balance in a bank account. That's called a compensating balance. A cash ratio that is especially useful for companies is a ratio of cash to monthly cash expenses. First, the monthly cash expenses are determined. So to determine that, they equal negative cash flows from operations. Negative cash flows is money you're spending. Positive cash flows would be money you're earning. So any money you're spending for operations and you divide it by 12. Why are you dividing by 12? Because you're looking for monthly cash expenses. So how much you expend for operations for the year, divided by 12, you get monthly cash expenses. The ratio of cash to monthly cash expenses can then be computed. So we had monthly cash expenses already calculated. We take our cash and cash equivalents, so what's our balance of our cash and cash equivalents, divided by how much we spend per month, and that's going to give us our cash to monthly cash expenses. That concludes the end of the lecture. Quick 2 minutes. Hope you enjoyed it.